Imagine this. You graduate college, and while your classmates are worried about debt, you've already built a small but growing investment portfolio. You're not starting at zero, you're starting ahead. All because you made one smart decision. You started investing as a student. This isn't a fantasy. It's completely possible. You don't need thousands of dollars, and you don't need to be a finance major. What you do need is a simple plan and the willingness to start right now. In this video, I'm going to walk you through exactly how students can begin investing, even with just $10, and why it might be the most powerful financial move you ever make before graduation. Let's get something straight. Time is your biggest financial asset, especially when you're young. While most students are focused on grades, internships, or surviving midterms, those who start investing even with small amounts gain a massive head start on wealth building. Why? 2 words: compound interest. Here's how it works. Let's say you invest just $100 a month starting at age 20. Now think about this. Many students think, I'll invest later when I have more money. But that's the trap. Starting early, even with $5 or $10, matters more than how much you invest. It's the consistency and time that do the heavy lifting. So, while most students graduate broke and financially lost, you can graduate with momentum, confidence, and a portfolio that's already working for you behind the scenes. Before you dive into your first investment, let's lay down a few crucial ground rules. Because smart investing isn't about hype, it's about habits. First, investing is not gambling. It's not about buying the next meme stock or trying to time the market. Real investing is strategic, long-term, and rooted in patience. You're not here to get rich quick. You're here to build real wealth slowly and securely. Second, you don't need a financial degree or thousands of dollars to begin. Apps like Fidelity, Robinhood, Acorns, and M1 Finance let you start with as little as the worn dollars. Third, prioritize high-interest debt first. If you're carrying credit card debt with 20% plus interest, pay that down before you start investing heavily. But student loans? If they're federal or have low rates, you can invest alongside paying those off. And finally, know your risk tolerance. As a student, you have time on your side, which means you can take a bit more risk than someone close to retirement. But don't invest money you'll need next semester. Keep investing money you can let grow over years, not weeks. These principles form your investing foundation. Think of this as your financial common sense. Once it's solid, you can build anything on top of it. Now that you've got the mindset, let's talk about the actual tools. What should you invest in as a student? Good news. You've got great low-cost, low-risk options, even on a tight budget. 1. ETFs, exchange-traded funds. These are your best friends. ETFs are baskets of stocks you buy with one click. Imagine owning a tiny piece of Apple, Amazon, Google, and hundreds more, without buying each stock individually. ETFs like VOO tracks the S&P 500, and VTI tracks the total US stock market, are top picks for students. They offer instant diversification and long-term growth. 2. Robo-advisors. Platforms like Wealthfront, Betterment, and Acorns do the heavy lifting for you. They assess your risk level and goals, then automatically invest your money in a diversified portfolio. It's like having a financial advisor in your pocket, but without the high fees. 3. Fractional shares. Apps like Robinhood, Public, and Fidelity allow you to buy portions of high-priced stocks. Want a piece of Tesla but can't afford $800 per share? Buy $5 worth. It's perfect for students who want exposure to big companies without the big price tag. 4. Dividend reinvestment plans, DRIPs. Some stocks and ETFs pay dividends, small payments just for holding them. With DRIPs, you can automatically reinvest those dividends into more shares, accelerating your portfolio growth. It's passive, automated wealth building at its finest. 5. High-interest savings for short-term goals. Not every dollar should go into the market. If you're saving for something in the next 6 to 12 months, like a laptop or travel, park it in a high-yield savings account. You'll earn interest while keeping the money safe and accessible. Each of these options fits the student lifestyle: low maintenance, low starting capital, and high long-term upside. Let's break this down into clear, actionable steps you can follow. whether you're in your dorm room, at a coffee shop, or between classes. This is your beginner's blueprint. Step 1. Set a goal. Are you investing for long-term wealth? For a car in 5 years? Or just to learn how the market works? Clarity helps you choose the right platform and strategy. Long-term? Think ETFs. Short-term? Maybe a savings account or a conservative portfolio. Step 2. Choose your platform. Pick a beginner-friendly app like Fidelity, Robinhood, or M1 Finance. If you prefer hands-off, go with Acorns or Betterment. These platforms let you start investing with no minimums, no commissions, and clean interfaces made for first-timers. Step 3. Link your bank and fund your account. It's as easy as connecting your student checking account. Start small, $5, $10, even $25 a month. Remember, the key is consistency, not the amount. Step 4. Choose what to invest in. Go with a broad market ETF, like VTI or VOO. These are low-risk, high-quality investments that mirror the market's overall performance. Avoid jumping into individual stocks or crypto unless you understand the risks. Step 5. Turn on auto-investing or schedule regular buys. Set it and forget it. Automate $10, $20 from your bank account every month. Over time, you won't miss the money, but your future self will thank you. Step 6. Track your progress but don't obsess. Check in monthly, not daily. Investing is a marathon, not a sprint. Your goal isn't to beat the market. It's to build wealth slowly and surely while you focus on school and life. This step-by-step process turns you from a college student into a long-term investor with less effort than studying for finals. Even the smartest students can fall into some classic traps when they start investing. Let's save you the pain and money by calling out the most common mistakes right now. Mistake number 1. Trying to get rich quick. Chasing crypto hype or meme stocks might sound exciting, but it's risky and emotional. Investing isn't a lottery, it's a long game. Avoid anything that promises guaranteed fast returns, because if it sounds too good to be true, it probably is. Mistake number 2. Investing with emotion. Instead of logic, markets go up and down. It's completely normal. But many beginners panic sell during dips or buy impulsively during spikes. Stay calm, zoom out, and stick to your plan. Reacting emotionally is how beginners lose money. Mistake number 3. Ignoring fees and hidden costs. Some platforms sneak in fees, and over time, those eat into your profits. Always check expense ratios on ETFs and avoid frequent trading that racks up charges. Look for platforms with low or no fees. Mistake number 4. Putting all your money into one asset. Diversify. Don't dump all your cash into one trendy stock. ETFs are great for students because they naturally spread your risk across many companies. Mistake number 5. Thinking you need to know everything before starting. You'll learn more by doing. Start small, invest consistently, and improve your knowledge as you go. Don't let analysis paralysis hold you back from starting. Avoid these mistakes and you'll already be ahead of 90% of beginner investors. Sticking to an investing habit as a busy student isn't always easy. Between exams, part-time jobs, and late-night ramen, money feels tight and time feels tighter. But consistency is what builds wealth, even in college. Automate everything. Set up automatic transfers, even if it's just $5 per week. When it's automatic, you don't have to think about it. It becomes a habit, not a chore. Use found money. Got birthday cash? A side hustle paycheck? A $50 refund from your school bookstore? Drop a portion into your investment account. Small windfalls are perfect for stacking your portfolio without touching your day-to-day spending money. Budget with investing in mind. Use the 50-30-20 rule. Spend 50% on needs, 30% on wants, and 20% on savings and investing. It's simple and effective, even if you're living on student income. Keep it visible. Use apps with clean dashboards that show your progress. Watching your money grow, no matter how slowly, is motivating. Over time, your mindset shifts from spender to investor. Celebrate milestones. First $100 invested, that's huge. First dividend, even better. Mark those wins. It keeps your motivation alive and reminds you why you're doing this in the first place. In college, it's easy to feel like investing can wait. But every small move today becomes a big result tomorrow. If you're watching this and thinking, I'm just a student, how much of a difference can I really make? You need to hear this loud and clear. You are in the most powerful position to build wealth right now. Why? Because you have something millionaires would trade fortunes for: time. You don't need to be rich to get started. You just need to be consistent. Even a few dollars invested each week builds momentum. And that momentum compounds, literally. Every dollar you invest in your 20s has the potential to turn into 5, 6, even 10 times that amount by retirement. The earlier you begin, the less you'll need to do later. That's the secret the rich already know. Wealth isn't built by working harder, it's built by starting earlier. So while others spend their college years broke and clueless about money, you can be stacking your future, one smart move at a time. This isn't about being perfect, it's about being proactive. Start where you are. Use what you have, and grow into the investor you were meant to be. Now, hit that subscribe button because your journey to financial freedom is just beginning, and the cash chapter is right here with you, every step of the way.